Here we go. Now we have an example of a cash basis to accrual basis question. Let's begin. So, Northern Star Company had cash collections of $100,000, made cash payments of $40,000, and reported cash basis net income of $60,000 for year 6. The company has determined the following balance sheet amounts for the beginning and ending of year 6. So, conveniently, we've got the change displayed out here for us. Sometimes you might have to calculate it yourself. Sometimes the question will give it to you like that. We have to compute the accrual basis, revenue, expenses, and net income. So this one, like many, is going from cash to accrual. We're looking for revenue, expenses, and net income. Well, good thing net income consists of revenue minus expenses. So I'm assuming we're going to get net income from just finding revenue and expenses. Let's run through the question here. I have the solution, and we also have the question pasted up here so we can refer back to it. Don't want to keep flipping back and forth between the slides. That might give you a headache, and that's the last thing you need right now because I'm sure FAR does that just by itself. When we go from cash to accrual revenue, just like if you went from bank to book, book to bank, you start with the respective balance that you have. So that is $100,000 of cash collections in the cash basis. So $100,000, $100,000. And that's how we're going to get to accrual basis. Just like if we went from bank to book, we start with the bank because we have bank, we're trying to find book. Next up, we need to add in the revenue earned during the year, but not yet collected from customers because cash basis doesn't take that into account, but accrual basis does. So here, that is going to be the $30,000 from the end of the year. That's revenue earned during year 6, but not yet collected from customers. And we're subtracting that out by $20,000, which is the beginning of that, the $20,000 here. Now, you might be asking me, why don't you just put the change in there and calculate that? Well, you can, and you should if that helps. This is just a breakdown showing you essentially every step of the way, right? So if we were to do this much quicker and without breaking it down on each line, yes, sure, definitely just put in that 10,000 here and you'd be good to go. Next up, we have minus 10,000, which comes from the unearned service revenue. So we take into account the unearned service revenue and the receivable here. And this should be sort of clear because we have two essentially revenue accounts and two expense accounts. So we'll probably take those into account when we deal with the expenses. So we have the beginning and ending, and beginning and ending, we're netting them together. So yeah, you really could have just done the 10,000 here and the 30,000 here. That would have given you our total of $40,000 of increase to get to accrual basis. The $10,000 of cash collected that will not be earned until future periods, that's a subtraction. Cash basis, you would have taken this into account, but with accrual basis, you do not. Similarly, you are going to add the $40,000 from the beginning of the year because that is cash collected in prior periods that was earned in year 6. That's how we get to $140,000 of accrual basis revenue. Definitely take some time and think this through, practice it over and over because it's tricky. It can definitely be tricky, and I definitely understand that because you have to think, okay, revenue is recognized when earned. What is this? Accounts receivable. Well, an increase in accounts receivable means that there is more revenue earned, but not necessarily collected. So that's why it's going to be a net positive. Similarly, when we have unearned service revenue, this is cash collected, however, not necessarily earned. So it's essentially the opposite of receivable. So that would be the opposite of accounts receivable. If we have a negative balance, that would be a positive for going to accrual because this is revenue that was collected but not earned yet. Moving on to expenses. We are going to calculate our expenses here and similar process. However, we have a couple more components. We start with our $40,000 cash payments of cash basis. Again, great starting point is the cash basis because that, and by great starting point, I mean that is the starting point. Just trying to make it sound a little more fancy, right? Where does this 10,000 capitalized fixed asset purchase come from? Well, I'm going to look at right here. We have a little note here, $10,000 in cash we bought a piece of equipment. That would be a subtraction because that is not a year 6 expense. That's actually going to be depreciated over the period. So for cash basis, and I know you might be saying to yourself, oh, but even if you use cash basis, you can still depreciate. You're totally right. And I've seen that in practice. That's how it works. This is theoretical CPA accounting, right? This is educational, theoretical, textbook based. We're just going to roll with it. So and this is why you practice questions instead of just reading the book, because you see tricks like this, and that's how you're going to pass the test with flying colors. So $10,000 in cash, we are subtracting that out because that's not an actual expense for accrual purposes. However, $10,000 in cash, we have a straight line 5-year depreciation schedule. That is 10 divided by 5. That gets us our $2,000 a year. So each year you're going to account for $2,000 of depreciation expense. All right, so that nets out to 8, essentially, subtracting out 8 from there. Now we have our normal expenses, our normal things we saw from before, except now we have prepaid insurance and salaries payable. Anytime you have payables, prepaids, unearned, receivables, basically anything that is not collected right now. So, all right, we're going to net those again together. So salaries owed from year 6 that are not yet paid, and salaries from year 5 that are paid in year 6. Remember, it's when it's accrued, when it actually happens, not when it's paid out, or, because if the salaries were accrued in year 6, which is the year we're working with, then yeah, you're going to include those for sure. So same process as we just saw before, you net them together and really think about it. Think about it for sure. So prepaid insurance, if we started with 4, our balance went up to 8, we are going to have a positive change in our expenses because we are going to it is tricky. It's super tricky. You got to think it through over and over. Questions like this, I mean, I can explain them, but I got to think it through over and over. It is rough. So it's going to have actually a negative balance here because these are expenses that you're accruing, but you haven't actually paid. So prepaid insurance, here we go. It's going to be a net negative here. And that's how we get to our $36,000 of accrual basis expenses. All right. Same as always, calculate net income. Super simple. It's revenues minus expenses, getting us to our final answer of 104.